Welcome to the Money Metals Midweek Memo. News and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. For every action, there is an equal and opposite reaction. This describes Newton's third law of motion. And in effect, what it means is when one object exerts force on another object, the second object exerts an equal force back on the first object, but in the opposite direction. So essentially, forces always come in pairs. Now, I know this is a physics concept, but it also holds true, at least to some degree, in economics. For instance, if you raise the price of something, demand for it's going to fall if all things are equal in the economy. So these are two forces that are kind of working against each other, right? Now, I know economics isn't exactly like physics. At its core, economics is the study of human behavior, and that can be tricky, right? There's a lot of subjectivity in human action. However, there is enough consistency across all of humanity that we can pinpoint certain economic laws, just like we can pinpoint specific laws of physics, right? The law of supply and demand is just one example of these laws of economics. And this is why I get so freaking frustrated when well-meaning people insist on doing things while ignoring these economic principles. Right? You can't just wish away gravity and jump off a bridge and expect not to crunch on the ground, right? In the same way, you can't wish away supply and demand and think that, well, just because it would be nice to raise everybody's wages, right? It'd be a good thing that you can just pass a law without any equal and opposite reaction the other way. And so many people ignore these fundamental economic principles, and they just willy-nilly impose various policies, usually governments doing it by law, and they often don't work because they are fighting against these economic forces. So I want to keep this in mind today as I delve a little deeper into the catch-22 facing the Fed when it comes to interest rate policy. Now, hopefully you listened to the show a few weeks back when I talked about this catch-22. In a nutshell, the Federal Reserve simultaneously needs to raise interest rates or at least hold them higher for longer to really put price inflation in its grave. But at the same time, it also really needs to cut interest rates because there is so much debt and malinvestment in the economy due to well over a decade of loose monetary policy. I'm talking about artificially low interest rates. I'm talking about money printing. Those forces, those economic forces that the central bank unleashed had consequences. Right? The equal and opposite force. And these consequences are still playing out today. In fact, we haven't seen a lot of these consequences manifest because, unlike gravity, which pretty instantaneously, when you jump off the bridge, economic laws and principles tend to play out slowly over time. But before I delve into all of that, I do want to talk a little bit about some interesting things that are going on in the gold market. Now, I'm going to focus primarily on gold in this little discussion, but a lot of this analysis also applies to silver because fundamentally silver is a monetary metal and it tends to track with gold over time. So kind of keep that in the back of your head as we go over some of the things that are going on. Now, we had a bit of a sell-off yesterday. I'm sure you're aware of that. We had the price of gold dropping something like 2% before recovering a little bit later in the day and then in the overseas trading last night. In fact, we had such a sell-off that we did test the $2,900 support level. And this was after right after gold set another all-time high, breaking above $2,950. I think it got as high as around $2,953 before it started selling off. And that $2,900 support level seems to be really firm at this point. It definitely held up yesterday. And as I was prepping for this show, gold was around $2,925 an ounce, kind of holding steady in that range with a little bit of selling pressure going on. Now, it's kind of funny because whenever we have a sell-off day like this, you immediately start hearing people say, oh, the gold rally is over, gold is done. And, I tell people all the time, you can't get caught up in these day-to-day price movements. You can't get too excited when gold goes way up in one day, and you can't get too excited when gold drops in one day. And bull markets in particular tend to climb what a lot of analysts call a wall of worry, right? It goes up in fits and starts, and it'll go up a little bit, and then people will get worried, and it might sell off. That's just the nature of a bull market. There's ups and downs. You always have to keep a focus on the underlying dynamics. Now, this doesn't necessarily apply if you're the kind of person who's trying to time those day-to-day price movements and make quick money. But if you are just investing for the long term, which most people are doing, you want to really focus on the underlying dynamics, the bigger picture, the longer-term trends. What's going on in the economy? What's going on as far as policy? Those are the things that you really need to focus in on. It was kind of funny because yesterday I actually wrote an article and I cited an analyst who said a price correction was brewing and that the metal was oversold and that there was a nice setup for profit taking. And sure enough, I hadn't even posted that article yet when gold started selling off yesterday morning. Now, these kind of price dips, they do provide buying opportunities, especially if you believe that we're still in a longer-term bull market. And an analyst quoted by Reuters made this very point. He said the dip was, quote, likely to stimulate good physical offtake and provide an entry point for those that may have missed the bull run. So again, buying opportunity. So what caused this sell-off? Well, one of the things that drove the dip is the threat of a trade war. That seems to be the kind of biggest economic elephant in the room right now. We've got Trump talking about tariffs. There's a lot of fear that we could really get into this broader trade war. Now, I think tariffs are kind of a double-edged sword when it comes to the precious metals markets. On the one hand, the thinking is that a trade war and a lot of tariffs are going to force the Fed to keep interest rates higher because tariffs are inflationary. Now, by the way, tariffs aren't inflationary, at least not when you properly define inflation. Truly, inflation is an increase in the supply of money and credit. It's money printing. It's money creation. Price inflation is a symptom of this broader monetary inflation. Now, tariffs can cause price inflation in a sense. They definitely raise prices on things that the tariffs are applied to, right? But absent government money creation, other prices in the economy are going to fall as the tariff prices rise, and things tend to balance out. Tariffs do not cause a general rise in prices throughout the entire economy, the way that money creation does. It's important to hold that distinction. And I did a show on this last month that I'll link to in the show notes page if you haven't listened to it. It's a good show to listen to because it kind of gets into the nuts and bolts and this distinction between monetary inflation and price inflation and how analysts and government people tend to conflate those two things and create a lot of confusion. Regardless, that's the thinking, right? Tariffs are going to be inflationary. It's going to cause prices to go up. The Fed is going to have to hold interest rates higher to compensate for this. And since gold is a non-yielding asset, higher interest rates tend to cause headwinds in the markets for the metal. Now, of course, you also have to consider price inflation, right? real price inflation. It's caused by money creation. And as the CPI rises, real interest rates actually fall. So what do I mean by real interest rates? Well, to calculate the real rate of interest, all you do is you take the quoted interest rate, whatever you hear on TV, and then you subtract the CPI. So right now, the federal funds rate is currently set at 4.5%. If you factor in a CPI of 3%, the real rate is only 1.5%. So the real interest rate isn't nearly as high as the quoted interest rate. Now, let's say the CPI moves to 3.5%, right? We get a 0.5% increase in price inflation, and the Fed holds rates steady. The real interest rate is going to fall to 1%. So unless the Fed actually raises interest rates, and I think that is highly unlikely due to reasons we'll get into here in a minute, rising inflation will actually be bullish for gold as real interest rates drop. So if the Fed does hold rates steady, they keep this pause on rate hikes in place, they don't raise rates, you're actually going to see a fall in real interest rates if price inflation reflected by the CPI continues to go up. Now, that's not even to mention the fact that gold and silver are inflation hedges, right? You want to have gold and silver in an inflationary environment to shield you from the erosion and the devaluation of the dollar. That's why you hold gold and silver in a portfolio. It's an inflation hedge. So it's silly to sell your inflation hedge when we're having clearly inflationary pressures. And then, of course, there's the other side of the tariff trade. Even looking at the more conventional analysis, it is going to cause economic chaos, right? And that's likely going to drive safe haven demand. And gold is one of the premier safe haven assets. So I don't think the trade war issue is nearly as bearish for precious metals as some pundits on CNBC might have you believe. I think you're still going to see this volatility when you hear talk of more tariffs, when you hear about the Fed holding interest rates higher for longer. Those kind of things are going to have this short-term impact. We're going to see these kinds of sell-offs just because of the psychological effect of them. But in the long term, looking at the bigger picture, I really don't think the whole trade war issue is really that bearish for gold. And there's also an interesting dynamic in the gold market that popped up last week that I want to mention. Gold flows into ETFs in North America increased drastically last week. And if this is any indication, North American investors are finally hopping on the gold bandwagon. So looking at the numbers, last week we saw 48.8 tons of gold flow into North American-based gold-backed funds. The last time that we saw weekly flows at that level was in April 2020, as the governments were starting to lock down economies for the COVID-19 pandemic. So the last time we saw this kind of gold flows into ETFs was during the pandemic. Now, some of you who are listening might not be real familiar with all of these terms. Just a real quick explanation. A gold ETF is backed by a trust company that holds metal owned and stored by the trust. And these ETFs are traded on the stock market just like stocks, right? So in most cases, when you invest in an ETF, it doesn't give you any amount of physical gold. You're not owning gold. You own a share of the ETF. You don't own the gold itself. But ETFs, their movement on the markets tend to reflect the price of gold. So it's a convenient way for investors to play the gold market by being able to trade this paper that's reflecting the price of gold. But it's always important to remember that owning ETF shares is not the same as holding physical gold. And I'll link to an article on the show notes page that explains that in more detail for folks who might be interested in learning more about that dynamic. Anyway, kind of getting back to the bigger picture and what this might be indicating. Demand for gold by central banks and investors in the East, so China, India, South Korea, Asia, that is really what has driven the gold bull market, especially in the first part of last year. Up until recently, investors in the West, particularly in the U.S., have largely remained on the sidelines. And many analysts believe that any kind of revival in Western bullishness for gold on the investment side could spark the next leg of this bull rally and drive gold prices to over $3,000 per ounce. So it's going to be interesting to see if this big flow of gold into ETFs in North America is just a kind of a blip on the radar, an anomaly, or is it the beginning of a bigger trend? And if it is, and if we're starting to see Western investors say, hey, we need to get into gold, that's really bullish and could well push gold over $3,000 an ounce. And I think that when you finally broach that $3,000 level, I think there's going to be a pretty quick uptrend, at least in the short term. That's a huge resistance level. And once it's cleared, it's kind of like if you think about it in terms of a battle, and you have this battle going on, and one side makes an offensive and breaks through the defensive lines, and then they're able to really push real fast, deeper into enemy territory. That's kind of what these resistance levels mean in the investment world. When they're broached, it kind of opens the dam and allows the price of whatever it is to go even higher. So keep an eye on that as we move forward. I definitely will be. And if you follow my writing and work over at moneymetals.com/news, and not just me, there's a lot of analysts that are contributing over there. It'll give you a good sense of what's going on as far as the broader gold market goes. And I mentioned earlier that this kind of applies to silver as well. Obviously not the ETF investment so much, but just this general bullish trend for gold. It's also bullish for silver. I wrote an article last week over at moneymetals.com/news on some things that are going on in the silver market, primarily the fact that silver is still way underpriced historically compared to gold based on the gold-silver ratio. And if you're interested particularly in silver, go check out that article, and it'll give you some of the dynamics that are going on specifically in the silver market. So I want to pivot now to this notion of action and reaction that I opened the show with, and talk about how it relates to Federal Reserve monetary policy, and particularly right now, interest rate policy. Now, remember the setup that I've already mentioned. The Fed is in a catch-22. It's walking a tightrope between keeping interest rates up to fight price inflation and cutting interest rates to give the economy the easy money that it yearns for, right? We have been watching the markets essentially beg for lower interest rates for well over a year. Ever since the Fed started raising rates, the market's been like, oh, no, we want lower interest rates. You hear President Trump kind of pushing on Jerome Powell that he wants lower interest rates. Everybody wants these lower interest rates because they feel like it's going to be better for the broader economy. So when we start looking at, kind of what's going on in the big picture of the economy, it's pretty easy to see the price inflation effect, right? Just go to the grocery store. You're feeling that inflationary pressure in your own budget, in your own pocketbook or wallet. Or if you're a data person, all you got to do is look at the CPI, right? You can look at the CPI data over the last 6 months, and you can see that instead of a continuation of this easing of price inflation, it's actually been heating up. Core CPI has been basically the same since last summer, and then we've seen the headline annual CPI number go up every month for, I think, 4 months now. But that said, you might question my assertion that the broader economy has a problem, right? You're probably not going to argue with me about the inflation problem because you're living it. But, if you listen to the news, if you look at the data, look at the GDP, the economy looks okay, right? It's not great, but it's not bad. You've got strong employment still. A lot of the metrics makes things look fine. And, when we talk about this, I like to remind people that things also looked fine in 2007 and even early 2008, even as the consequences of Fed monetary policy after the dot-com bubble had popped was rotting out the foundation of the housing market, right? Everybody's like, oh, no, there's no problem. There's some stuff going over here in subprime, but we're fine. The economy's great. No problem. Don't worry, right? And if you look close enough, you will find some things in the broader economy, in the data, that tells you, well, things aren't quite so fine. And while everybody has pretty much conceded that the Fed was right to put interest rate cuts on pause because price inflation remains sticky, they're still desperate for those rate cuts, as I've already mentioned. And that's because whether they'll say it out loud or not, they all know that higher interest rates have consequences in an economy that is buried in debt. It's that action and reaction, right? You have higher interest rates. That's going to impact the economy, especially when you've already had the reaction to artificially low interest rates, which incentivized borrowing and created this debt bubble to begin with. Furthermore, we're starting to see the squeeze of these higher interest rates on the economy, particularly in the housing market, right? The housing market is particularly sensitive to interest rates because, well, pretty much everybody has to borrow money to buy a house. Some people can buy in cash, but by and large, most houses are bought using debt. So if we look at mortgage rates, they actually peaked in the fall of 2023 at around 7.8%. And that was also coinciding with the peak of the Fed hiking cycle. And there is a correlation between Federal Reserve interest rates and mortgage rates. They tend to move pretty much in tandem. So if the Fed is raising interest rates, you're going to see mortgage rates increasing as well. Now, mortgage rates started to drift lower over the next year through 2024. And then they fell sharply last September after the Fed cut rates for the first time. And you'll remember that September rate cut was what I like to call a supersized rate cut, right? They went for a 50 basis point or a half a percentage point interest rate cut, which was kind of surprising because even then, if you go back and look at what I was writing and saying at the time, I was saying, inflation's not dead. There's still signs of inflation. This is premature. But nevertheless, they went big with the rate cuts, which again is because everybody's desperate for the easy money and they recognize the problems of a high interest rate environment when you have all of this debt. So we saw this big dip in mortgage rates around that same time. They bottomed at around 5.2%, so almost a 3% drop. But since then, mortgage rates have risen steadily, and they hit 7% again in mid-January. Now, they've dipped a little bit through the first couple of weeks of February. I think they're like at 6.87%, so really still pushing that 7% handle. And, of course, cause and effect, forces and equal and opposite forces, this rise in mortgage rates has had a significant chilling effect on the housing market in the United States. And we can see that in the January data. Sales of existing homes plunged by 4.9% month on month in January. And they were only 2% higher than a year ago. Now, 4.9%, almost 5%, doesn't sound too terribly bad, but you've got to put it in context. The housing market was bad to start with, so we're dropping off of a number that was already pretty tepid. In fact, 2024 was the worst year for existing home sales since, get this, 1995. If we go back and compare to January 2021, so pre-pandemic, home sales were down 36% in 2024. One analyst that writes over at Wolf Street called this basically demand destruction, right? We're seeing a destruction in the demand for housing due to high prices, and they never came down after the inflation of the pandemic era. And then we're coupling that with higher mortgage rates. And we can see this reflecting in other aspects, other data points in the housing market. The slowdown in sales has resulted in this inventory glut. There are a lot of houses for sale now. The supply of unsold existing homes in the market jumped to 3.5 months in January. So in other words, if no other houses came on the market, we would have enough inventory for 3.5 months of home sales. And that was the highest level since January of 2019. So again, higher than pre-pandemic levels. Meanwhile, active listings and the median number of days before a home sells also rose to the highest level since January 2020. And, again, this makes sense, right? For every action, there is an equal reaction. And home buyers are reluctant to wade into the market with prices still high and mortgage rates above 7%. Now, people might be saying, I'd kind of like to sell my house. I could take a profit, maybe downsize or upsize. But they're looking at this 7% mortgage rate, and they're like, I'm not going to do that. According to Redfin, which is a company that does a lot of real estate data, 82.8% of homeowners have mortgage rates that are under 6%. Right. So this creates what they call a lock-in effect, where people avoid selling if at all possible. I mean, obviously, sometimes you have to sell, you have job situations and whatnot, but by and large, people are avoiding sales in order to avoid these higher mortgage rates. Nobody wants to go out of a 4 or 5% mortgage and go to a 7 or 8% mortgage. It's going to drastically increase your house payment, even if you were to downsize. So as a result, what we're seeing right now is this kind of slow collapse of the housing market. And I think that the housing market is kind of a microcosm of the broader economy, right? We often see the impact of higher interest rates in home sales first because of the market's sensitivity to higher interest rates. So it's the housing market's kind of a canary in the coal mine. And, these higher interest rates also have a similar impact on other sectors in the economy, right? Higher interest rates increase the borrowing costs for autos, or any other big ticket item. A lot of people will use debt to buy appliances or, boats, whatever it is. So higher interest rates is going to impact the sales of all of these things. And when that happens, it slows the economy down. And then there are the credit cards. This is another huge problem. I've talked about this before on the show. Over the last several years, many people have turned to plastic to make ends meet. I mean, it's fair to say that the U.S. economy basically runs on Visa, MasterCard, and American Express and Discover. And, it's funny because when you listen to mainstream analysts, whenever you see credit card debt increasing, the common mainstream take on this is that, the consumer is very confident right now. They're willing to borrow money. Yay, this is great. And they view an increase in credit card debt as a positive for the broader economy. And, I get that. And it may be true to some degree. You may be more willing to borrow if you feel confident in your job. You feel confident that you might be getting a raise. On the other hand, and the data bears this out, a lot of people are just using credit cards to make ends meet. Inflation has buried them. It's buried their budget. They're not getting raises that are keeping up with the rising prices. So they're turning to credit cards in order to close those gaps. They're using credit cards to buy everyday items like groceries. And, I'm not just speculating on this. Again, you can see it in some of the survey data that's out there. And when you look, it's interesting because during the pandemic, a lot of people paid off credit card debt, right? We got all of these stimulus checks and people weren't doing anything. So they had extra money and they paid down their credit card debt. And we had credit card debt was under $1 trillion and in a pretty good place. We also saw a big increase in savings. A lot of people took that stimulus money and the fact that they weren't going on vacation, they weren't going out, and they socked that money away in savings. Since then, savings has evaporated, and we now have credit card balances that have expanded exponentially. Credit card balances grew by $18 billion just last December, right? Basically, consumers charged Christmas. And this was a 20.2% increase in credit card debt. And when I say credit card debt, this is revolving debt, which is primarily reflecting credit cards. Right now, that revolving debt is at a record of $1.38 trillion. And of course, meanwhile, credit card interest rates have barely budged despite the Federal Reserve cutting interest rates by 1 percentage point. The average annual percentage rate on a credit card is still at 20.09%. We still have some companies that are charging rates as high as 28%, which is only slightly down from the record high that we saw on the average credit card rate that was 20.79% that was set last August. Credit card rates are high and they're staying high, one analyst told ABC News recently. So people aren't getting any interest rate relief. Again, this is why so many people want to see the Fed cut interest rates. This is clearly unsustainable, right? And yet, the economy depends on this consumer spending, which is depending on credit cards to keep plugging along. And I saw another disturbing bit of data yesterday along these same lines. There's been a huge increase in the number of corporations that are falling behind in servicing their debts. Since Q4 of 2023, delinquent corporate bank loans have spiked from around $21 billion to approaching $29 billion today. And, this is because big corporations tend to roll over their debt. And as older loans, lower interest rate loans mature, they're being forced to borrow at these much higher rates to pay them off. And so obviously this increases their interest expense, which is a huge expense for a lot of corporations. And this explains why corporate bankruptcies hit a 14-year high last year. Now think about that for a minute. There were more corporate bankruptcies last year than when the government shut down the entire economy. So, high interest rates are a problem. And low interest rates are a problem because of inflation. What is a Federal Reserve central banker to do? This underscores this catch-22 that I've been talking about. The Fed is walking a tightrope between runaway price inflation and a collapsing economy. And then the question is, which way is it going to fall? How is it going to come off of the tightrope? I've used the analogy before, but the central bank has basically addicted the economy to easy money. When you take away a drug addict's drug, he goes into withdrawals, right? It makes him sick, he gets the shakes, he can't function. The Fed is the drug pusher in this scenario, and the dealer doesn't want to kill his customer, so, he kind of slowed down the flow of the drugs, but ultimately, he's going to give him more drugs, right? Even though that risks an overdose. This is the state of the economy in a nutshell, a drug addict. And like the drug dealer is always going to default to selling the drug to his customer, the Federal Reserve is always going to default to easy money. That's the fork it knows. Now, it doesn't have to, but that's what it does. That's the historical trend. That's the way central bankers think. If the economy gets shaky enough, the Fed will cut interest rates. It will run quantitative easing when it gets bad enough, and by that I mean print money. Inflation be damned. It will pick saving the markets and keeping the economy moving over keeping prices down. And this is why I am long-term bullish on gold and silver. I know that the central bank is going to inflate. I've said this before. Inflation is not a mistake. It is a policy. Inflation is by design. They just don't want so much inflation that you notice. The Federal Reserve and the government is going to devalue your money. Period. End of story. So I want real money. I want gold and silver. And as I mentioned earlier, when we see these price dips, it's a buying opportunity. And, if we are truly in a scenario that we may be pushing to that $3,000 resistance level, now is the time to buy. It might be a great time to talk to a Money Metals, precious metal specialist. You call 800-800-1865, and you can talk to them. These guys are great, and not just guys and gals. And they're going to help you. They'll help you figure out what products will work for you, how gold and silver can fit into your investment portfolio. They'll answer your questions. So give them a call today. Or if you're the kind of person who doesn't like to talk on the phone, you can go to moneymetals.com and you can actually chat with a precious metals specialist online. Or if you know what you want, you want to buy some American Gold Eagles or, some silver or whatever it is, silver bars, you can just do that right online, but you want to do it today. You don't want to wait. You don't want to be sitting there when gold is over $3,000 an ounce saying, oh man, I wish I bought some gold. So that is a wrap for a rather long episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and more over at moneymetals.com/news. And if you want to get the latest news and information that relates to gold and silver right in your email box, make sure you sign up, get on our email list. You're going to get a lot of great information through that. Of course, you can subscribe to the Midweek Memo podcast on your favorite podcasting platform. And when you do, you can also tune into our Market Wrap podcast that airs every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver. This week, I'm going to be talking to JP Cortez over at the Sound Money Defense League about some cool things that are going on at the state level relating to sound money. So do that today. Thanks for listening to this show. Again, I say this every week, but I really do appreciate that you take a little time out of your day to listen to the show. There's a lot of stuff out there you can listen to, and you choose to be here. I appreciate that. Thank you so much. I hope you have a fantastic rest of your week, and I will be right back here to talk to you again next week.